After years of saving, Danny and Rachel can finally open their brand new restaurant. They shop around for a location until they finally stumble upon the perfect spot. Rachel is the chef of the restaurant and Danny handles business operations. Rachel is so proud that people are loving her recipes. What a beautiful sight. But after month 2, they uncover a big problem that, if not solved, could force them to shut their doors. Hi, I'm Nathan from Accounting University, and in today's video, you will learn exactly how the break-even point works in 5 minutes. Danny started to add up all of their costs and look at their revenue. To their shock, they realized that they are losing money every single day. Food supplies, rent, insurance, employees, utilities, marketing, and more. The problem was their costs were bigger than their revenue, which means there is no profit, only losses. Danny, the operational manager, suggests that they need to figure out the bare minimum in sales needed to cover all of their costs. In desperation, Danny hits the books and begins to account for every cost and sales that they are bringing in. What Danny needs to figure out is something called the break-even point. The break-even point is the bare minimum in sales to cover all costs, so that profit equals 0. Costs are comprised of 2 categories, variable and fixed. For our example, we will say that the change in customers is tied to our total variable costs. So if number of customers increase, so do our total variable costs. And if number of customers decrease, so do our total variable costs. Now with fixed costs, it's kind of what it sounds like. No matter if customers increase or decrease, fixed costs stay the same. And here are some examples of variable costs. Cost of food, hourly employees, electricity costs, variable marketing, and variable admin costs. Some fixed costs are monthly rent, insurance, equipment, and license fees. We place our costs in something called a contribution margin formula that looks like this. Sales minus variable costs equals contribution margin. For contribution margin, you can think of it as something that contributes to pay off your fixed costs. Now, if you're enjoying this video so far and want to take your grades to the next level, consider checking out my Accounting Student Accelerator. For a limited time, 85% off. Link is in the description. Now, as Danny was running the numbers, he wanted to figure out the number of plates to be sold to break even each month. Now, for our first break-even point problem, we're going to solve the break-even point in units. Now, what does that mean? We're trying to figure out how many plates must they sell to cover all of the costs. In September, we had fixed costs of $3,600. Food cost per plate was $4. Labor cost per plate was $3. And variable overhead was equal to $1.50 per plate. Now, to get our variable cost per plate, we add up these 3 numbers. And we get $8.50 in variable costs per plate. Now remember our contribution margin formula. Now we plug in our variable cost per plate of $8.50. And let's say that on average, each plate sells for $13. So we take $13, subtract $8.50, and we get a contribution margin per plate of $4.50. So we have our September fixed cost of $3,600 and our contribution margin per plate of $4.50. Next, we divide the 2 to get our break-even point. So we take $3,600 divided by $4.50 and we get 800 plates. They must sell 800 plates in the month of September to fully cover their costs. Now let's say that Danny wants to figure out how much in sales dollars are needed to cover all of their costs. So this is called the break-even point in sales dollars. Now from before, we know that our fixed costs in September are $3,600. And now we are looking for something called the contribution margin ratio. In our contribution margin formula, the ratio looks like this. We take our contribution margin of $4.50 and divide it by our sales per plate of $13. And we get a contribution margin ratio of 35% or 0.35. Jumping back into the problem to get our break-even point in sales dollars. We take our fixed costs and divide it by our contribution margin ratio, as this equals our break-even point in sales dollars. So 3,600 divided by 0.35, and we get $10,286 in sales that are needed to cover all of their costs. If you enjoyed this video, hit that like button so it can reach more people, and consider subscribing so you don't miss another video. Until next time.